You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is practicing corporate and securities law attorney and co-founder of Verify Investor, Jor Law. Jor is the co-founder of Homeier Law PC, where he practices corporate and securities law, including helping companies take advantage of alternative forms of capital raising, such as Regulation D, Rule 506C offerings, and crowdfunding. He is also the co-founder of VerifyInvestor.com, the resource for accredited investor verification trusted by broker-dealers, law firms, companies, and investors who insist on safety and reliability. Jor is frequently sought out as a speaker internationally on the topics of capital raising, investing, EB-5 finance, securities, and other corporate matters relevant to attorneys, entrepreneurs, and investors. Jor is licensed to practice law in California and New York and received his JD from Columbia University and his BA from UC Berkeley. Before we get on to the show with Jor, I'd like to run through a couple updates with you guys, if you would. I got a few minutes here. And first off, I know you guys have listened in. You've been listening in for the past couple of months, and I've been mentioning about this book that we're writing. Charles and myself, actually, it's our entire team, three principals at our group here at sunrisecapitalinvestors.com. We've been writing a book on mobile home park investing, and we're writing it because we feel like there's not many resources out there that are in depth about this topic, okay, about this niche. And as you know, this is my niche of choice. So I'm telling you all this because we're going to give you a free copy. It's just being loyal listeners to the show. We're going to make sure that you get a copy of it as soon as it is completed, and it'll be very soon. As soon as it's completed, you'll get a copy before anyone else, before we go put it up for sale on Amazon, okay? Absolutely free. So what you need to do is get on our VIP list by texting the word Kevin, just my first name, Kevin, to 41411. Again, text Kevin to 41411, and you'll be the first to receive an absolutely free copy of that book once it's completed. And next up, guys, if you're an accredited investor and you're looking for a passive investment opportunity, then I want you to check out, take a couple minutes and go check out the partnership opportunities that myself and my team have at our company, Sunrise Capital Investors. We're currently looking for investors who are seeking above average returns to partner with us on our deals. Now, as you know, I think you know, if you listen in, you probably know that I really do have my finger on the pulse. We keep our fingers on the pulse of the various other investment opportunities that are being offered out in the multifamily and the commercial real estate space, as well as the single family space. And I haven't seen anything that can really hold a candle to the opportunity that we're offering. So to get more information about our company and download our investment prospectus, you can go to sunrisecapitalinvestors.com, or you can call us directly by dialing 888-260-9455. Again, that's sunrisecapitalinvestors.com, or call us directly, 888-260-9455. And lastly, if you find yourself in the Tampa Bay area, as you know, I'm based in Clearwater, and I love meeting others that share my same passion for real estate investing. So it doesn't matter if you like mobile home parks, or you like shopping centers or office or single family homes, or maybe you haven't even gotten your start yet, you don't even own a property. Either way, I love talking shop, and I love grabbing coffee or a beer or lunch, whatever you have time for with those that are visiting, here where I live, here in Tampa Bay area. So if you find yourself here, shoot me an email. Let me know when you're coming so we can coordinate our schedules and possibly hook up. You can reach me directly on my personal email, kevin@kevinbuck.com. And now, guys, without further ado, I'd like to welcome Jor Law to the show. Jor, how you doing today?
Very good. Thank you. How are you?
Oh, I'm doing fantastic. I want to thank you for joining us. And you're out on the West Coast, and so it's bright and early out there right now. So appreciate you waking up and spending your first part of the morning with us. And it's kind of ironic. Jor, your last name, it's Law, and you're a practicing attorney. I mean, was that meant to be or what?
Yeah, there probably was some sort of unconscious psychological influence throughout my life. Luckily I was called Law, not something else.
Yeah, right. Exactly. Well, if you would, Jor, I mean, I gave you an introduction there, but I'm sure it goes a lot more in depth than that. But maybe just take a few minutes and tell our listeners a little bit more about yourself and your background and how you got into this business, both from a security standpoint, but also even in the entrepreneurial side with Verify Investor. What led you there?
Yeah, I mean, in general, I come from a relatively entrepreneurial family. We've always been investors and business operators of some sort, including in real estate and in finance and whatnot. Growing up, as business guys, our family generally was not a big fan of lawyers. Growing up and I saw that, I realized that, okay, instead of fearing lawyers, I really kind of wanted to become one to understand, what it was. And then ultimately I was going to become a business person. It turns out that, once I got into the practice of law, I thought it was actually pretty interesting, and I stayed a lawyer much longer than, I probably ought to have been. So at any rate, so I am a lawyer now and, continue to practice law, but I've had the good fortune of branching out into other areas of law and business as well. Verify Investor was something that came up because, frankly, all law firm clients needed that service, and there wasn't a provider in the marketplace that I was comfortable with. At the time that we started it, it was relatively early. Most of the other providers at that time just weren't right there yet. They weren't there from the privacy security perspective that we were a little bit comfortable. They weren't there from a legal compliance perspective, so we were a little bit uncomfortable with that as well. So I just decided, I know startups, I know developers, I know the law. I'm just going to build this so I can use it.
That's fantastic. Yeah, where there's demand, right? You got to fill the void. Well, before we dive into Verify Investor, Jor, I want to bring up a point that you made when you first kind of told us about yourself and your background. You'd mentioned that growing up, your family didn't really care for lawyers too much, right? Why is that? I mean, is there a specific reason? Because I had everyone kind of assumed certain things, and I had assumed, and we didn't talk about this before we started the show, but I had assumed maybe you came from it was generational, like as far as a occupation, being an attorney. But it sounds like you might be the first in the family to go to law school. Is that correct?
Yep, I'm the first. In general, I think, we've been, they're much less anti-lawyer now, but I think in the early days, anytime you heard from a lawyer was usually not a good thing.
Yeah, right. That's true. Very true. Fair enough. I'll leave it at that because I think that's a true statement. So let's talk about Verify Investor a little bit. And for those that don't know what it is and don't know who it serves, just go a little bit more in depth about the service itself and who you cater to.
Yeah, let me start really quickly with an overview of securities laws, which I'm sure
Absolutely.
Most of your listeners already know. But basically in the U.S., when you raise capital, even if it's from your friends and family and things like that, when you raise capital, you're really supposed to comply with securities laws. So assuming what you're raising is securities, right? So the laws essentially say that, if you're going to raise capital, then you should register your securities with the SEC. And that's a long process that's expensive. So what most people do is they look for some sort of exemption that says, okay, well, we don't need to do this in this case because we're only targeting people that are overseas, or we're only targeting accredited investors, people who are rich and don't need this protection. So one of the core methods of exemption was this thing that was called Rule 506. And historically, it was just an idea of that, hey, if you're only going out and soliciting through your own network, people that essentially know you, privately, then these people need a little bit less protection, especially if most of them, if not all of them, are accredited investors. So those laws came down from a period where information was less accessible and things like that. So there was this need to make sure that people had access to information by making companies register. Well, fast forward many decades, and now information is pretty easy to find. You can go online, you can even remotely take satellite views for free on Google, and there's a wealth of diligence services that you can order from your home, just from your computer or through a phone call. So a lot of people said, look, we really want to be able to take advantage of this new economy where sharing and information is more prevalent, and we'd like to be able to generally solicit and advertise investors. And heck, other countries are starting to allow this. You should let us as well. And what do you care anyway? They're all accredited. And, so I think the lawmakers listened to that and thought about it and said, you know what? That's fine. We'll let you generally solicit and advertise, but in exchange, you have to prove that the people that invest actually are accredited investors. Mm-hmm. So if you look at the old Rule 506, which is still available today and renamed as 506B, mm-hmm. you can still privately raise capital and then just trust that your investors are accredited when they tell you they're accredited. But there's also this new powerful method of capital raising called 506C, and that allows you to generally solicit your deal, but now you have to prove that your investors are accredited. Mm-hmm. And that's the service that we provide. Proving that an investor is accredited requires a pretty invasive search, and also there's liability if one does it wrong, so we kind of solve both problems with Verify Investor. Got it.
And just for those that might not know the definition of what an accredited investor is, can you define it for us?
Yeah, sure. There's multiple categories of accredited investors. So one could be an accredited investor simply because they're a bank or insurance company, or if they're a company that has more than $5 million of assets and wasn't created specifically for the purpose of investing, or if a company's owned entirely by equity owners who are accredited themselves, then the company will derive its own accredited investor status from those owners. Mm-hmm. For most people, they think about accredited investor, however, from an individual. How do I, as an individual, qualify as an accredited investor? Mm-hmm. And there are a few ways to do this. One is you could be an insider of the company, executive officer or insider of the company, and that makes sense because if you can't invest in your own company, that's kind of a shame. So they did create a category for that. And then the two main categories that are used are one that is tied to high net worth and one that is tied to high income. So on an income test, it's either you individually or you with your spouse have income of 200 individually or 300 with a spouse for each of the last 2 years and reasonable expectation of achieving the same thresholds in the current year. And for the net worth, it's basically $1 million net worth test, ignoring the value of your primary residence. Mm-hmm. And, in general, the liability on your primary residence is ignored as well. But if the liabilities were incurred recently, within the last 60 days, or if the liabilities exceed the value of your primary residence, then they do hurt your net worth.
Okay, got it. And you'd mentioned something about the 506C, the exemption regarding general solicitation, how that's really changed. The capital raising. You made a comment about that. I want to talk about that for a second, and just in the beginning of this call here, I generally solicited a 506C offering that we currently have available. And so what I want to hear from you, Jor, is just really from your perspective, because you deal with investors day in, day out. This is your business. Both through your law firm and also through Verify Investor. But how have you personally seen the 506C exemption change this industry, allowing the general solicitation? Or I guess the better question is, how have you seen general solicitation change this industry of capital raising?
Yeah, I think it's amazing. I think the industry is still fledgling. It's still kind of growing. I think there's a lot of fear of the unknown in the beginning. So 506C didn't take off as quickly as everybody would have hoped. But 506C conceptually is great. Right now, it's called, this, special form of crowdfunding, but really in the future, it's just going to be called real estate finance. There are quite a number of people that think 506B will eventually go away and be replaced by 506C simply because the power of being able to generally solicit is greater than the power of operating behind closed networks. If you look at the old way of doing business, if you were an entrepreneur with a great business, but you didn't happen to have a network, it's very, very difficult for you to find investors. You'd have to go find someone else who had a network, partner with them, pay him an exorbitant amount of fees to find an investor. So a lot of deals just didn't get out in the marketplace that probably could have been out in the marketplace. And a lot of investors didn't actually hear about these opportunities. So what happened is you had people who were already wealthy and sophisticated in these private networks, and they were getting all of the opportunity that could have gone to everybody. Mm-hmm. So 506C is really great because it democratizes that. It doesn't mean that if you have a network, you're not valuable anymore. It just means that if you don't have a network, you're not left behind. Mm-hmm. If you're savvy, you've got a good deal, and you can market and put together a marketing plan, then you can let the public decide if your deal is good or not.
Yeah.
So that it really helps companies now raise capital and let people know about the deals, but it also helps investors as well because it gives them options to invest that previously had been available only to people in the know, mm-hmm. and usually people in the know were people that lived in large coastal cities, that had this type of connection. And that's not great for a country when you're isolating, quite a large number of the population.
No, I agree with you. And you made a comment about some people think that 506C might actually replace 506B, where 506B would just go away. What do you mean by that comment? I mean, I know that this is just conjecture, but do you think, is your own personal opinion, do you think that it would just go away to where there is just 506C and you can literally generally solicit to both accredited and non-accredited? Because 506B is just your immediate network, right? Someone that you've got a prior relationship with can be accredited, and then you can have up to, and correct me if I'm wrong, is it 25 or 35 non-accredited investors?
It's 35, but 35, because it's a little bit more onerous if you take non-accredited investors, most people that use 506 actually don't take any non-accredited investors, even mm-hmm. when they have the option to.
So why would someone actually do, if they're not going to take a non-accredited investor, why would they do a 506B versus a 506C? What are the pros and cons of each?
I think in general, if you have that private network and you don't have to generally solicit, then it's okay to do the 506B, and maybe it's preferable to do the 506B. It's just easier. There's a little bit less compliance with respect to having to do the accredited investor verification check. But it's also kind of what everyone's done before. The accreditation requirements are still relatively new. Not every investor is familiar with it, and sometimes, frankly, verification can be somewhat annoying. So if you could do a 506B and fill out your round, it's something worth considering. If you're a company that expects to expand and grow and raise more money, then even if you could do a 506B, you might start thinking of a 506C, so you could start building out your brand mm-hmm. for future capital raises when your network suddenly is not big enough to handle the size that you've grown to.
Yeah, okay. Have you seen any kind of pushback? And I'm more speaking to the, I'm going to call them the old school investors, the ones, prior to 506C even being around, the ones that were in the know, right? They were in the network. They knew about all these good opportunities that existed. Back then, before 506C came out, they didn't have to really go through this verification process, where now if then offering that they're looking at as a 506C, they do have to go through the verification process. Have you seen pushback from those investors that just don't like change? they don't want anyone digging into their business?
Yeah, certainly that happens, and I can tell you from a personal story. That happened to me. I own a verification company, and I think it's annoying to get verified. So there was a deal that I needed to get verified for, and I chose to pass on that deal because I was just too lazy.
Interesting. Okay.
and well, like a few months into it, like 3 months later, that deal, it was a tech company that few months later, they got acquired by someone. Oh. And because I chose to not take the time to get verified, and honestly, for me, it's, I know how to do it, so I already have all my evidence ready. It honestly wouldn't have taken me more than 10 minutes. I lost on this opportunity. So I think that certainly right now there are some investors that go through the process and say, forget it, I'm not going to do this, and they're annoyed at it. But over time, I think you'll find that more and more people just realize, okay, it's part of the necessary aspect of investing.
Right, this is the new world. This is what it is now.
Basically.
Okay,
right.
So
if you're going to go buy a car, you got to fill out the car paperwork. If you're going to go get a mortgage for a bank, you got to go fill out that paperwork. If you're going to invest, you're going to have to do the verification paperwork. I think over time it should be fine. And I would say that it's not just individual investors that are going through this. VerifyInvestor.com has processed verifications for, country funds and things like that, extremely large billion-dollar companies or funds. So it's pretty much everyone has to go through this. And you'll see some people seem to care about it a little bit more than others, but many people just go along with it.
Yeah. So the moral of the story there is, guys, if you're one of those old school investors that I classified you as, and you're not used to this whole verification process, and you see an opportunity that looks phenomenal, but yet you don't want to go through a verification process, just know that you might be passing up on something that's incredible that you're going to kick yourself in the butt for later on, right? Like the tech company that Jor didn't go through with. So I want to talk about the actual verification process a little bit, Jor, and just really what are you guys looking for? What do you dig into as far as personal financials, business financials, real estate, other types of assets that are held? Can you give me like the 10,000-foot view of what that looks like?
Yeah, there's a couple overarching principles behind verification and how we analyze it, right? The first concept is that it is verification. So what that really means is that, the people that kind of come over and just send you like a personal financial statement and say, oh, well, this lists all my assets and liabilities, or this is a self-declaration of income. Well, that's not good enough. That essentially is the equivalent to self-attestation, which is, principally what they were trying to avoid. They were trying to say that someone needs to go and prove this. So that's one concept, right? That it truly is verification. Now, also another concept that we employ here at Verify Investor, and it's not necessarily the right path. It's the path that we chose. Is we decided that the reviewing person should just review. They shouldn't value as well. So if you're both appraising and you're evaluating and you're verifying, then there's a little bit of a conflict of interest. Now, that doesn't mean our reviewers don't always do this, right? If someone presents something that so clearly and blatantly looks like it must at least have a value of X, then our reviewers might use the discretion and say, okay, well, clearly the value of this has to be at least this much. I think it's reasonable for me to give them this valuation. That's fine. I think, they're not really in the role of trying to value, but it's so clear what the value is that they're just using it as the evidence that's been presented and saying, okay, that's fine. As a reviewing attorney that's verifying only, I'm comfortable with the evidence that's been presented to us. Mm-hmm. So that's another concept. The last concept I think that I want to kind of address is that it's a reasonable standard. So it's not an absolute standard. And, herein lies a good thing in terms that there's flexibility, but it's also a bad thing in the sense that reasonableness can differ person to person, right? A investor might say, it's clearly reasonable for you to assume this. And the reviewer could say, no, I don't think that's reasonable. And in fact, one reviewer could think differently from another reviewer, whether something's reasonable or not. But certainly for the folks that are doing this out there and holding people to absolute standards, I think definitely you have to step back a little bit and think what's reasonable. Okay. The SEC did also provide some guidance. If you want me to talk about the guidance that's been provided and what that means for investors, I'm happy to do that as well.
Absolutely.
Okay, so verification is reasonable steps, and there's this idea of you could take principles-based reasonable steps, which are basically you do facts and circumstances, and if you think it's reasonable, then okay, fine, it's good enough. The issue there, of course, is if you're a company and you think something's reasonable, the government can later come in or a jury can later come in and argue that it wasn't reasonable. And if it wasn't reasonable and you thought it was reasonable, there's no defense that says, well, I thought it was reasonable. The only test is it reasonable or not? And if someone said that they thought it was not reasonable, it doesn't matter that you thought it was. You've broken the law. And the issue with that, of course, is that even if you've done it wrong for one investor, you've jeopardized theoretically your entire offering. So a company that cuts corners on verification doesn't just threaten the company, it threatens every investor in that deal. So the SEC did come out and say, okay, well, we'll also give you a few safe harbor methods of verification. And there's 3 that I'll disclose, that I'll talk about since they're the most useful ones. The first is they said, well, if you're an individual investor and you're investing through income and you have to prove it, then we think you should use U.S. tax documents. If you get U.S. tax documents to prove last 2 years' income, and then you get a written statement that they still have reasonable expectation of achieving the same income this year, then that is going to be a reasonable verification if you do it exactly that way. And there's still some risk. You could go through that process and someone could still attack you and say, yes, you used this methodology, but how do we know you really use this methodology? So you're still open to some attack, but at least you followed the right methodology, or at least you can argue that you followed the right methodology. Another safe harbor they gave was one for individuals that are qualifying off net worth. And there they basically said, okay, well, for your assets, you have to prove them by showing, your bank statements, brokerage statements, appraisals, etc. Common sense things. And then for your liabilities, you have to list them out and disclose that, you've listed out all your liabilities. And just because you could lie about your liabilities, we also want someone to go grab a consumer credit report on you. And therefore, if there are any liabilities you haven't disclosed, they'll at least see them through that. So if you collect all that information, you determine that the net worth is still $1 million and exceeds it, then that's another safe harbor. Of course, the same attack could be made, which is like, well, how do I know you did this properly? The person doing this, were they properly trained? Show me your files. You could still get attacked for failing to follow the safe harbor procedure, but at least there is a procedure. Now, the third method of safe harbor, which is the safest way to get verified, is basically if you have a third-party letter from a licensed attorney in good standing in all the jurisdictions he or she is licensed in, or a licensed CPA, or a registered broker-dealer or registered investment advisor. If you've got a letter that has kind of the right substantive language on there that basically says that attests that this person or this entity is an accredited investor, then that's gold. You can rely on that letter as a safe harbor verification, and it's probably the safest way to get to verify investors as well. So those are the 3 safe harbors. You'll notice, of course, that 2 of the safe harbors only guide to individuals. They were completely silent on giving any safe harbors for entities other than the third-party letter method.
Okay, great. I want to talk a little bit about the liability side of things, since we're kind of somewhat on this topic. So, assuming that that an investor goes through a service like yours with verifyinvestor.com, does that shift the liability then from the sponsor of that offering over to Verify Investor? As far as
no,
okay.
No, it just means you have someone to sue if things go wrong, I guess. And if you think about the laws how it works, right? Just because you hire, outsource something to an escrow company or a bank or a law firm, it doesn't mean that you can't get sued. It just means that when you get sued, you might be able to now go sue someone else. So the primary liability always stays with the company. So it's important that they don't just pick someone else and say, it's not my problem anymore. It's always your problem.
Sure. Okay.
So
if the SEC comes,
good vendors.
The SEC comes breathing down our neck about a potential investor, lying or forging this the verification process, we come back on you or whatever company did the verification. So it just goes down the line.
Yeah, essentially, right?
Okay.
But the SEC wouldn't even know that we did the verifications probably, so they'd come to you.
Right.
In the case of forgery, of course, if they knew it was forgery, they'd leave you alone because, they're not trying to punish companies for, dealing with bad investors. If you knew it was forgery and you still took it, then yes.
Right.
But if essentially you didn't know that information was being fraudulently provided to you, then it'd be entirely fine for you to rely on the evidence that was provided.
And your reviewers, how do they come up with the values of, like, let's just say real estate? And it could either be a single family rental, or it could be commercial income real estate. I mean, do they use proprietary tools that you guys have developed, or just some general standards practice, like single family home Zillow is probably one of the most well known, or Trulia. There's a couple different ones out there like that to find values. Can you speak to that a little bit?
Yeah, basically, we put the information in the hands of or we put the burden of providing evidence in the hands of the investor, because they know their asset the most. And, if someone's trying to qualify off being an accredited investor, and there's, 3 or 4 objective appraisals out there, we're going to trust that the investor is going to find the one that's, most beneficial for the investor. And they'll also know the value of their asset much better than, someone else will initially know the value of their asset. So anything that's basically a non-biased third-party valuation from someone that's reasonably qualified to do this works. So for real estate, the gold standard, of course, would be a real estate appraisal. But since that costs money, then other options might be a letter from a real estate agent or a broker, kind of with the estimate of the value, which almost all of them will give for free. There could be, for certain types of assets, sites like Zillow or Trulia that will give a kind of like the Z estimate, or like their estimated value, and we can all argue about how accurate those are, but at least they're reasonably accurate, and they are non-biased third-party valuations. And some people use just their tax assessor statements, and obviously that generally undervalues properties by a lot, but sometimes that value is enough.
It's enough, right?
Accredited already,
right? Yeah. Okay, got it. I want to shift gears a little bit, if we could, Jor, and I want to talk. We've been talking about verified investors and the service it provides, and verification of accredited investors, whether they want to invest. Or I guess for the 506C offerings, what it would be for. I want to talk about your involvement as a passive investor. So you came from a family of investors. You've been an active investor, or I guess you could say active or passive. Either way, I mean, you've been an investor for a long time, in addition to being an attorney and also the co-founder of Verified Investor. So from an investment perspective, I want to ask you the question of, do you have a preferred asset class that you invest in? And if so, why?
No, I don't really. I mean, I'm really all over the place. I've invested in banks. I've invested in real estate. I've invested in, startups, of all types. And, really for me, I'm not claiming to be a great investor. I just happen to enjoy doing it. So, the asset class isn't as relevant to me.
Okay.
Everything is really just, kind of a gut feel and a risk-reward ratio. And in some investments, I'll do a lot more diligence and analysis. And for many investments, I actually don't do very much diligence and analysis. Especially kind of in the tech and startup space, it's, a lot of that is just kind of a gut feel thing. And all the diligence that I do on some deals doesn't necessarily mean they pan out, better than the ones where I don't do any diligence. So really, I've been across the board, and I think for me, I've tried to pick a balance between future, growth and then current income. So, probably I've been overweight future growth, and now that I have family, I realize okay, maybe I need to do stuff more that gives current income.
Sure, absolutely. Okay, so really, I would classify you as an opportunistic investor. I mean, it's not really asset specific or class specific. It's just you're looking for opportunities that get you return on your money, on your investment overall, that are winners. So,
yeah, I'll basically look at anything. But when they say there's the 3F money: friends, families, and fools, I might be the fool.
I wouldn't say that. It seems like you're doing quite well, my friend. What advice? I'm going to switch it to the opposite side of the spectrum now. So, what advice might you give a passive investor that might be listening to the show that is seeking out an opportunity to invest in? Because as we talked about now with the general solicitation opportunities that are out there, I mean, you're seeing stuff on Facebook, on Twitter, all over social media, billboards. I mean, in the newspapers, if people still read newspapers, they're everywhere. And this didn't exist, or I guess when was it actually passed? When was the when was the 506C actually implemented into action?
So it was signed into law in 2012, and then the 506C itself and the verification requirement became effective in 2013, September.
Okay, so it hasn't been very long at all.
Not long at all.
What advice would you give those investors that are now seeing all these opportunities and they've never invested in a passive opportunity like a Reg D 506C before? What should they be looking for? I mean, what are the big gotchas or mistakes that you see some new passive investors make?
Yeah, I think number one, the entire industry will need to improve the education. Now that you're going to the masses, the American education system doesn't teach people how to invest and think about these things. That's just not part of the core curriculum. Mm-hmm. And that ultimately is a disservice to investors that, are now starting to invest. But it's also a disservice to the companies that seek them because, there is no good deal or bad deal, right? There's just assuming the deal is honest, it's a deal that's right for that investor. So a lot of people that go crowdfund and find investors, let's say something happens and their investor is not happy. It's not necessarily the case that deal was bad. It might just be the case that deal was bad for that particular investor, right? Mm-hmm. So I think education for how to value these types of things is pretty important to have. Beyond that, right, and that's kind of more of an overarching social commentary, but beyond that, I think when it comes to real estate investing, location, of course, but don't be enamored by sexiness and glamour and prestige of a project. Really look at the financials of the project and see if it makes sense. I'm a lawyer. I draft these PPMs for people, and even though the PPMs are drafted in a manner to expose all the risks, they're also drafted in ways where we present the information in a positive light, right? So you have to understand that every company that's going out and raising money is generally going to talk about its own project positively, and that doesn't mean they're committing fraud. It's just they drank the Kool-Aid. They wouldn't be doing that project if they didn't like it, right? So you as an investor need to look at it and really understand what is this project. And if you're investing for like cash flow returns and things like that, then you really have to kind of run through the numbers and figure out, does it make sense that this does that? And in a cycle like where we are now, you might start thinking about like what happens if we're high in a cycle and there's a downturn. How well is this project protected from that? And I think one of the last things I would say, and one of the things I wish I had respected when I was, made my first real estate investment, my first two real estate investments on my own that failed miserably, both of them, is look at the structure. A bad investment with a bad project with a good terms and good structure could be a great investment, whereas a great company with bad terms and a bad structure could be a horrible investment.
Yep. Absolutely. No, that's a great point. I want to add to it one other thing that if someone's asking me for advice, if they're looking at different opportunities out in the marketplace and maybe it's their first investment, you got to look at the sponsors. You got to look at the people that are running the show. I mean, the deal is incredibly important, right? I mean, the sponsors that are running the show, look at the track record. How long have they been in this niche? What's their previous experience? I mean, are they are they trying to sell you a 300-unit multifamily property, but prior to this, they've never owned real estate in their life? Not saying that's a bad thing, but just dig a little deeper. I always like to say, try to find a reason not to do the deal, right? And if all the weighing evidence keeps pushing you back to like, God, it just seems like a home run opportunity, do your due diligence. And if it ends up that way, then great. But try to find a reason not to do a deal.
Yeah, I would second that. There's nothing more important than a great management team. This doesn't mean that you can't invest in startup teams, et cetera. It just means it's a different risk profile. But having folks that have been around the block that know what they're doing, track record doesn't mean that this deal is going to go well necessarily, right? It doesn't guarantee that. But track record does mean that you've got a team that knows what they're doing. And if something comes up and they have to adapt their strategy or adapt their management, that maybe they'll have the experience to do that, right? And you also know that if they've have a history of doing extremely good deals, very likely they're going to have a history of, they're going to keep doing this in the future. And as while you're looking at track record, you also have to consider the type of sponsors that are out there. Some sponsors will let deals die because that's the right fiscal decision. Some other sponsors will do everything in their power to save the deal, even if that means, they make a little bit less profit themselves.
Yes, absolutely. It's a great point. And now, Jor, you've shared tons of great information with us today. I really appreciate you coming to the show. We're going to enter what I like to call a golden nugget segment now. We're going to wrap things up after this. And what I'd like to ask of you is if you could leave one final golden nugget of advice or wisdom that may inspire and motivate our listeners as they progress in their real estate investing career, what would that one last golden nugget be?
Oh, this is going to be a tough one. We've talked a lot about Verify Investor, and I think maybe I'll share a golden nugget there, or what I think is a golden nugget there, which is only get verified through a safe source. In this day and age where information is being stolen, you really want to focus on privacy and security. So only verify with safe sources. If a company is trying to do the verification themselves, or they're doing a methodology that seems suspicious, go somewhere safe. And the second thing would be don't get too arrogant. Give the bare minimum amount of information that you need to give in order to get verified.
Mm-hmm. Okay.
I too often I see people trying to prove how wonderful they are, and frankly, we don't need to know that. We don't care. We just want you to get verified as painlessly as possible in as safe a manner as possible. And usually that means if you qualify with 2 pieces of evidence, don't volunteer 8 more.
Gotcha. So just don't open up a purposeful can of worms if you don't have to. Yep. Fantastic. Well, Jor, this has been so much fun. I really appreciate you coming on the show today. And for those that want to learn more about Jor and his companies, you can go visit him at verifyinvestor.com, or for his law practice, it's homeierlaw.com. And I'll spell that for you. It's HOMEIERLAW. Again, homeierlaw.com or verifyinvestor.com. And Jor, that's all we have for today. I really appreciate you coming on the show, and wish you the best of luck with everything that you're doing. And hopefully we'll talk again soon, my friend. You take care, okay?
All right. You too. Thank you.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.